This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Triple play. All three major averages close at records as investors focus on fundamentals and turn a blind eye to some remarkable assertions about the president's inner circle.
Record prices. Demand for cars and trucks remains very healthy, even as shoppers pay more and more for them.
New therapy. A medication for a rare disease comes with a hefty price tag, but also some new ideas on how to pay for it. Those stories and more tonight on Nightly Business Report for Wednesday, January 3rd.
Good evening, everyone, and welcome. Well, it may be cold outside, but Wall Street is hot. The Dow is closing in on 25,000. It's within 80 points of it, in fact. The S&P 500 today traded above 2,700 for the first time ever. And the Nasdaq solidified its position well above 7,000. So why? Well, the latest readings on the economy were strong, and there's optimism that corporate profits will rise again this year. Now, that's what investors focused on today, brushing off a double dose of drama in Washington. First came controversy over presidential tweets about nuclear buttons. Next was a bombshell White House statement in which Mr. Trump excoriated and basically excommunicated his former chief strategist, Steve Bannon. Bannon's offense? Giving incendiary quotes to the author of an upcoming tell-all book about Trump's first year in office. But market jitters? No way. The so-called fear gauge on Wall Street fell to near record lows as stocks hit those new highs. The Dow Jones Industrial Average rose 98 points to 24,922. Nasdaq added 58. The S&P 500 gained 17. So what comes next for stocks? Bob Pisani takes a look.
You might think it's time for stocks to pause, and that would be not unreasonable given the big run-up we've had. The S&P was up 20% last year. But that's not the prevailing opinion. The street is mostly bullish. You can't blame them. All of the textbook conditions for higher stocks are still in place. A global economic expansion, strong employment, low inflation, and low interest rates, with the Federal Reserve expecting to continue on a very slow path toward higher rates. So the traders are mostly expecting the good news to continue. There's talk of an infrastructure spending plan now. There's talk that wages may finally start to move up, but not too much. And some strategists even believe the U.S. could see 3% growth in GDP this year. That hasn't happened since 2005. Now, there's still bears out there, but they're down to arguing that the valuations are too high. And that's true. Stocks are expensive. But if the economy keeps expanding, it's not hard to argue that it could stay expensive. They also worry about some external event like a terrorist attack or a blow-up in North Korea of some kind. But until it happens, the market is showing no signs of worry. And finally, inflation is a worry, but many argue that even with economic growth, inflation is likely to remain relatively muted. Finally, despite all of the castle intrigue in Washington, the market continues to tune all of that out. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Wall Street may have sidestepped past today's D.C. drama, but in Washington, it was impossible to ignore. Not just because of the gloves-off brawl between the president and his former chief strategist, but because of what that upheaval could mean for the Trump White House and its agenda. Steve Bannon was considered an architect of the Trump campaign and of the White House's nationalist economic prescriptions. But in a new book written by author Michael Wolff, Bannon calls the 2016 meeting between top campaign aides and a Russian lawyer treasonous. He also predicts that financial crimes like money laundering would be the downfall of several members of the president's inner circle. And in a reference to the president's son, Bannon said, quote, "They are going to crack Don Jr. like an egg on national TV," end quote. The president says Bannon, whom he fired, has lost his mind. John Harwood is in Washington tonight to kind of sift through the Donnybrook and what it might mean for the president's plans on immigration and infrastructure and much more. John, there was a lot of political drama in Washington today. Let's first start with why this book is getting attention, and part of it is because of its author, Michael Wolff.
Well, Donnybrook's a good word for it, Sue. Michael Wolff is a longtime journalist. He's a guy who's got some attitude. He's drawn some criticism in the past for embellishing stories that he has told. However, he gained enough trust from Steve Bannon and others in the White House that he got extensive access, spent a lot of time as a fly on the wall in White House meetings, and that is going to lend the anecdotes he has and the brutal depiction he makes of President Trump, it's going to invest that with a little bit more credibility.
Why would the White House give such access to a known sort of gossipy journalist?
Well, it's an interesting question. Michael Wolff is somebody who had done a lot of reporting and was intimately familiar with Rupert Murdoch. Rupert Murdoch's a very important person to Donald Trump. And so I imagine that that lent him some credibility that helped him gain access. But Sarah Sanders, the White House press secretary, said today that it was Steve Bannon who, in the end, provided most of the entree to the White House to Michael Wolff. But there's no disputing that there was a lot of entree.
What does this do to the fact that the White House wants to push through several key initiatives, immigration reform and infrastructure? Does the noise surrounding this book derail that effort?
Well, I think all of those efforts to make legislative progress on other issues face an uphill fight to begin with. But the more chaos you have in the White House, the more you have splits within the president's own team, not to mention splits between the president and Republican leaders in Congress, the more difficult it is to move forward. And that comment that you mentioned about Steve Bannon's view that the meeting with the Russians at Trump Tower was treasonous, that signals a real problem with the Mueller investigation, which is ongoing, and that could provide a bigger threat to the agenda than anything else.
John, thank you so much.
You bet.
John Harwood in Washington tonight.
Back to the economy now, and there are a number of positive reports on it. Manufacturing expanded more than expected last month, capping the strongest year for the sector since 2004. According to the Institute for Supply Management, there was a surge in new orders and an increase in export orders. A measure of manufacturing employment, however, fell.
And construction spending hit a new high. Builders spent more than expected on construction projects in November, the fourth consecutive monthly gain. Strength in single-family construction offset weakness in apartment buildings. Non-residential construction also rebounded after a recent slide.
For the first time ever, the U.S. auto industry has recorded 3 straight years of sales, topping 17 million vehicles. Results for December show the industry ended the year on a strong note, driven by demand for pickups and SUVs. And as Phil LeBeau reports, in some cases, Americans are paying more than ever for the models they're buying.
It may have been a chilly end of December for most of America, but showrooms across the country were hot. How hot? The pace of sales last month was well above what many were expecting. A robust economy, low unemployment, and strong consumer confidence made it a busy end of the year at dealerships.
People are feeling pretty good. Maybe there's some bonus checks coming your way at the end of the year. And there is that mindset that starts in Black Friday and then kind of goes to the end of the year that, you know, you got to get in before the start of the new year to get a great deal.
What's selling? Ford's F-Series had its best year since 2005. GM sold almost 1 million crossover utility vehicles last year, an all-time high, while Honda and Nissan both set new records for U.S. sales. The average price paid for a new vehicle now tops $36,000, but healthy incentives are helping close the deal with many buyers.
They're looking at some of these deals and think, you know, I feel good about my job, I feel good about the overall economy, these deals seem really great, why don't I just buy a car? I think that's probably driving a lot of the sales.
After 7 straight years of rising sales, the auto industry cooled off slightly in 2017. Still, sales topped 17 million vehicles for a 3rd straight year. Will it be 4 straight in 2018? Probably not. Over the last 6 years, Americans have bought almost 100 million new vehicles, so demand is expected to finally slow down. Phil LeBeau, Nightly Business Report, Chicago.
Today's economic reports underscore the economy's strengthening fundamentals, something that has not gone unnoticed by the Federal Reserve. At the central bank's most recent meeting, policymakers expressed growing confidence in the economy, but they also appeared uncertain over the potential impact of the new tax policy. Steve Liesman is in Washington tonight.
Minutes of the December Federal Reserve meeting show officials debating strong but contradictory forces affecting the economy, some of which could lead to higher interest rates this year and some of which could lead to lower rates. While the minutes showed little change at the center of the outlook for rates in the economy, they suggested that differences between hawks and doves on the committee may have widened, and both seem to be digging in their heels. Now, most Fed officials support continuing a gradual approach to raising interest rates and saw the outlook for growth in the labor market as both strong and strengthening. But it was over the impact of the tax cuts and the outlook for inflation where the two sides seemed to part ways. In fact, a few went so far as to say they're, quote, not comfortable with 3 rate hikes this year, which is the median call for a Fed official that they forecast for 2018. And a hawkish few want even faster tightening because financial conditions, that is, long interest rates, had not tightened enough, and they worry that low rates risk financial instability. On tax cuts, many expect them to lead to higher consumer and capital spending by business, and most Fed officials boosted their GDP projections because of the tax cuts. Several see the possibility that these cuts could raise potential GDP, which some were cautious on the effect, saying that companies may use it for mergers and acquisitions or for debt reductions and stock buybacks. On inflation, again, the average Fed officials thinks inflation is going to move back towards the Fed's 2% target. But the doves are worried that inflation will stay below the Fed's objective for longer than they currently expect, and several are concerned that low inflation has reduced expectations for consumers. Hawks, on the other hand, worry about elevated asset values as a soaring stock market and low volatility in the markets. They see these low rates could pose a risk to financial stability over time. All this means that the job of incoming Fed Chairman Jerome Powell will be tougher when he takes over from Janet Yellen in early February. He'll have to negotiate the uncertain effects of tax cuts and low inflation and work to find a consensus between the two groups that increasingly look to be on different sides of the debate. For Nightly Business Report, I'm Steve Leisman.
Still ahead, a new medicine, a steep cost, and some new ideas on how to pay for it. Pfizer will partner with a biotech company to develop a gene therapy to treat ALS, a disease that affects nerve cells in the brain and the spinal cord. The gene therapy will also treat a related neurodegenerative disorder. The partnership with Sangamo Therapeutics deepens Pfizer's investment into DNA-based treatments for rare diseases.
The Food and Drug Administration last month approved a treatment for a rare form of blindness, marking the first approval of a gene therapy for an inherited disease. The cost of this one-time treatment is $850,000, but along with the high cost comes new potential payment plans. Meg Terrell explains.
Medicine has been pursuing the promise of gene therapy for decades. The goal, to deliver healthy copies of genes to make up for ones that cause disease. What makes the approach revolutionary is that it's aimed to only be administered once to fix the problem. It was only in December that the United States got its first gene therapy approval for a drug from Spark Therapeutics. It's called Luxturna, and it treats a rare inherited retinal disease that can lead to blindness, often affecting kids early in their lives.
Let me see that.
In clinical trials, Luxturna helped improve patients' vision in low light. It doesn't necessarily restore perfect sight, but patients have described major differences.
Before, I couldn't see snow when it was like the little snowflakes when they were falling. And then I went outside when it was snowing, and I was like, oh, I can see the snowflakes.
And with new approaches to medicine come new prices. A key question for gene therapies is how to pay for a treatment that's only administered one time versus chronic therapies patients take for months, years, or even their entire lives.
As we've reflected over the course of the last couple of months, we've done a fair amount of work to establish what we think is the value of Luxturna. We think that the value of Luxturna is in excess of $1 million. We've tried to balance the concerns about accessibility that patients, families, and healthcare professionals have voiced, the concerns about budget impact that we've heard from payers, as well as the need for us to build and create a path for a sustainable business model.
Wall Street had been expecting a price of at least $1 million for the one-time treatment. The drug's price announced today, $850,000 in total. It's the highest sticker price for a medicine in the U.S., but that doesn't necessarily make it the most expensive to the system. Many drugs for rare diseases are priced at many hundreds of thousands of dollars per year and are taken chronically. Spark announced a series of new payment models along with the price tag, including tying rebates to how well the drug works initially and over time, alleviating the need for hospitals to purchase the drug themselves, and a proposal to the Centers for Medicare and Medicaid Services to implement payment in installments. The company announced an agreement with health plan Harvard Pilgrim and said more insurance coverage announcements will come in the next weeks and months. And Spark is not the only company working on gene therapies. Luxturna is just the first of this new kind of medicine to come to the market in the U.S. Others are in development for hemophilia, sickle cell disease, muscular dystrophy, and other maladies. So Spark's pricing and payment plans may lay a foundation for what's to come. For Nightly Business Report, I'm Meg Terrell.
Let's turn our attention now to the pricing and payment plans that Meg just referenced. So how likely is it that other drug companies will offer installment plans, even rebates, depending on a drug's effectiveness? Here to discuss is Vincent Chen, a senior analyst at Bernstein. Mr. Chen, welcome. Good to have you with us. Let's start with the idea that a medicine's cost might be adjusted by how well it performs. Is that something that's really feasible?
I think that's actually something we're starting to see a little bit more of over time. I think it's potentially an effective way to facilitate access. I think it's something that's attractive to payers. And I think it's something we're going to see more of as we start seeing more motion towards more innovative pricing plans, especially for some of these high-cost drugs. If we think about the arguments around drug pricing, one of the constant areas of debate is this idea of how can you better align the price paid to the value that's actually delivered in terms of healthcare. And rebates or some sort of outcomes-based pricing, tying the actual price of a drug to the outcomes achieved, that's certainly one way to do that. We've actually seen a few examples already. In the United States, I would point to Novartis has a cell therapy for cancer that was recently approved, and the price there is $475,000 per year, but CMS will only pay if patients actually respond.
Right.
Or another example would be for some of the high-priced cholesterol drugs, some plans have deals in place where they pay full price only if patients see the lowering cholesterol that was seen in trials.
I was also interested in, I guess you would equate it to almost an annuity system for drug payments, where you would pay, the insurer would pay every year a certain amount as long as the patient kept responding. So it almost amortizes out their cost. And it allows them to plan, and it allows the patient to know that they're going to get their treatment.
Yeah, so the installment plan that Spark announced today, that's interesting because it essentially allows payers to spread out the payment over multiple years. So rather than paying $850,000 up front, maybe you pay $425,000 this year and $425,000 the next year. That's useful because of two reasons. The first is if you're a smaller plan and you may not be able to foot the bill for an $850,000 drug this year, that allows you to space it out and actually absorb that blow a little bit better. The second would be, as we get to gene therapies that treat broader populations.
Can I just ask you, Mr. Chen, does it also, to a certain extent, shield the company from criticism over the high price of the drug if they offer these types of alternatives?
My sense that it does a little bit in terms of it helps to, there's certainly some positive publicity that comes for both the payer and the pharmaco in terms of better aligning value delivered to the price paid. I think in this case, the bigger impact probably is in terms of the greater access that it affords Spark, in terms of more plans being willing to open the gates to patients who have this rare disease.
All right, Vincent, thank you very much. Vincent Chen with Bernstein.
Thank you.
Dominion Energy will buy its struggling rival, and that's where we begin tonight's market focus. Dominion says it will buy SCANA for more than $8 billion, taking on costs associated with SCANA's failed nuclear project. Last year, SCANA abandoned plans to finish 2 half-built nuclear reactors in a move that sparked a federal investigation. Under the deal, Dominion will pay more than $1 billion to customers who were forced to pay for the unfinished plant. Dominion Energy shares off nearly 4% to $77.19, while shares of SCANA popped 22% to $47.65. An online report alleged Intel chips found in millions of computers around the world carry a flaw that could allow hackers access to personal information. Tech website Register reported programmers are rushing to fix the vulnerability, but there's a cost. The updates are expected to slow down computers by about as much as 30%. Now, Intel has refuted the news, saying it was inaccurate and was planning to disclose the issue next week. Shares of Intel fell 3% on the news to 45.26. Meanwhile, AMD shares popped 5% as that chipmaker is believed to not be impacted by this particular security issue.
American Express said it expects to report a fourth quarter loss as tax reform takes a more than $2 billion bite out of profits. The credit card company also sees earnings for the year below initial estimates. Shares rose fractionally nonetheless to $99.55. And Tesla delivered about 1,500 of its newest Model 3 vehicles in its latest quarter, and that missed Wall Street's estimate by a mile. Wall Street figured on more than 4,000 deliveries. The automaker said it achieved record deliveries in total when you include other models. Tesla shares initially fell in after-hours trading. They ended the regular day down 1% to $317.25.
A deep freeze has gripped large portions of the U.S. Last night, we told you how the cold is creating record demand for natural gas. Today, there was even snow in Tallahassee, Florida, for the first time in 3 decades. And even Orlando, where people usually go to escape winter headaches, is feeling that chill. Eric Chemi is there.
You normally think of Orlando, Florida as the place for sunshine, hot temperatures, and fun vacations. But not this week. Freezing temperatures in Orlando have led to many closures, in particular the 3 major water parks in town, Aquatica, Volcano Bay, and Typhoon Lagoon. That's a big blow for an Orlando economy that revolves around tourism. Last year, the city welcomed 68 million visitors who had a $64 billion economic impact.
It's a big waste to buy sunscreen this week. It's a lot more rain and a lot more frost than I was expecting.
The 3 water parks are owned by major companies, SeaWorld, Disney, and Universal, who can handle the temporary closures. Each company still has kept open their traditional theme parks in Orlando, despite fewer visitors, and the companies have their locations around the country and the world to offset any losses here. But it's a lot of the smaller businesses local in town that don't have the ability to withstand as much of this decline.
It really shut down after a while just because, it's raining. Nobody really wants to come out and, get out their houses. It's really cold. It's really wet.
Local residents are not used to this type of cold. Some said they planned to stream Netflix until the weather got better. Schools across the state have closed. There's fear about damage to citrus crops, and major airlines are letting flyers cancel or reschedule their flights without penalty.
I'm not really prepared if there was snow. I guess if there is, I just stay put. Netflix, some covers, and we have fun.
45-degree high temperatures might seem like a very nice day in most of the country, but that's not what residents of Orlando are used to. We talked to the local manager at a Home Depot store, and he said they are completely sold out of space heaters, and they're almost sold out of firewood. For Nightly Business Report, I'm Eric Chemi in Orlando, Florida.
Coming up, Amazon's search for a second home.
I'm Scott Cohn. Amazon says it wants a second home that's not unlike its first home in Seattle. Denver has a lot in common with Seattle that's good and bad. Is this the place? We'll have the story coming up on Nightly Business Report.
Sometime in this new year, no one's saying quite when, Amazon plans to announce the location of its $5 billion second headquarters. More than 200 cities have submitted bids, and Scott Cohn is traveling to as many of them as possible before the big announcement. Today, he's in the mile-high city of Denver.
Amazon says it wants its second headquarters to replicate the original in Seattle. And no city is more similar than this one. Both have mountains. Seattle has the Cascades, Denver the Front Range of the Rockies. Both have skilled workers. Washington State with the largest concentration of STEM workers, Colorado with the most educated workforce overall, according to the Census Bureau. Both even have legalized marijuana. Colorado Governor John Hickenlooper, a former Denver mayor, thinks this city is a natural.
Denver is one of the top cities in America. Plus, we're a can-do, that kind of Western attitude that's exemplified Amazon.
The state's 75-page bid, submitted in October, touts Denver's workforce, clean energy, and mass transit, including the nation's 5th busiest airport. There is no better place for Amazon's second home than Colorado, the governor writes. Others agree. Back in September, before anyone submitted a bid, the New York Times declared Denver the winner, citing the city's lifestyle and affordability, coupled with the supply of tech talent from nearby universities. But the article and Colorado's proposal don't mention some of the other similarities between Seattle and Denver. In fact, Denver has many of the same issues that forced Amazon to look outside Seattle to begin with. Those skilled workers are in short supply. Unemployment in Denver is just 2.6%, driving wages to among the highest in the nation. And just like Washington, Colorado has an infrastructure problem, with more than 2/3 of roads in mediocre or poor condition. Add to that a nagging pension shortfall in the state, and the governor is working to control expectations about the Amazon bid.
There are a lot of great cities in America, and there are a lot of it's a healthy competition in that sense.
For now, Denver is among 238 cities vying for 50,000 jobs. Amazon has them all right where it wants them. For Nightly Business Report, I'm Scott Cohn in Denver.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Matheson. Thanks from me as well. Have a great evening, everybody, and we will see you back here tomorrow.